$0. No portfolio, no inheritance, no side income to invest. Just a regular job, regular bills, and a decision to start building something that actually pays you back. That is exactly where this video begins. Not with someone who already has $100,000 invested and wants to optimize. With someone who has nothing yet and wants to know the most honest, realistic path from $0 to $500 a month in dividend income. I am going to walk you through the exact framework step by step. How much you actually need to invest to reach $500 a month. Which investments I would use to get there. How to start when you genuinely have no money sitting around. And the one compounding trick that most beginners skip entirely that quietly doubles your timeline to the goal. By the end of this video, you will have a complete, actionable plan. Not a theory, not a motivation speech, an actual plan you can start executing this week regardless of where you are right now. Let us get into it. The first thing to understand is the math behind $500 a month in dividend income. Because once you see the real numbers, the goal stops feeling impossible and starts feeling like a calculation you can solve. $500 a month is $6,000 per year. That is your target. Everything else is just figuring out how to reach that number. The formula is simple. Divide your annual income target by your expected dividend yield and you get the portfolio size you need. At a 4% average yield, you need $150,000 invested. At a 6% average yield, you need $100,000. At an 8% average yield, you need $75,000. Most people hear $100,000 or $150,000 and immediately feel deflated. That is a lot of money. And if you are starting from $0 today, those numbers feel far away. But here is what the math also shows you. You do not have to get there all at once. You get there in small, consistent steps where every dollar you invest starts generating income immediately. And that income gets reinvested to buy more shares, which generate more income, which buys more shares. The compounding is not glamorous in year 1. It becomes genuinely powerful by year 5 and genuinely life-changing by year 10. If you are building a dividend portfolio and want to follow this journey in real time, hit subscribe. I post honest portfolio updates and income breakdowns every single week, and this is exactly the kind of content I build around. Before we go further, quick question for the comments. What is your starting point right now? $0 and just beginning, somewhere between $1 and $10,000 already invested, or further along and just looking to optimize? Drop your number below. I reply to every single comment, and knowing where you are helps me make more useful content for exactly your situation. Now, the most important question for someone starting from $0, where does the first dollar come from? This sounds obvious, but it is actually where most people get stuck. They wait until they have enough to make a meaningful investment. They tell themselves they will start when they have $500 or $1,000 or when the market dips. And months pass, sometimes years. The actual answer is you start with whatever you can automate right now. Most major brokerages, Fidelity, Schwab, even apps like M1 Finance, allow you to invest in fractional shares with as little as $1. That means you do not need $100 to buy a single share of anything. You can start with $10 and own a fraction of a high-quality dividend-paying ETF today. The starting amount is not the point. The habit is, the automation is. Setting up a recurring weekly or monthly transfer of whatever you can genuinely afford, even $25 a week, even $50 a month, and investing it consistently without touching it is the entire foundation of this strategy. $25 a week is $1,300 a year. $50 a week is $2,600 a year. At those amounts compounding over time with dividends reinvested, the numbers are not as distant as they feel right now. Now, where would I actually invest that money? For someone starting from $0, I would begin with one simple, proven, diversified dividend ETF rather than picking individual stocks. The reason is straightforward. Individual stock picking requires research, monitoring, and risk management that is genuinely difficult when you are just beginning. A dividend ETF gives you instant diversification across dozens or hundreds of companies with a single purchase. The two I would use as a foundation are SCHD, the Schwab US Dividend Equity ETF, and a high-dividend ETF like VYM from Vanguard. SCHD currently yields around 3.5 to 4% with a strong track record of dividend growth. VYM yields slightly higher and gives you broad exposure to large-cap dividend payers. Together, they form a core that is durable, diversified, and compounds consistently over time. For the portion of the portfolio where I want to push the yield higher, I would add a covered call ETF or a high-quality BDC, a business development company. JEPI from JP Morgan, for example, currently yields around 7 to 8% and generates income through a combination of dividends and covered call option premiums. Main Street Capital, one of the best-run BDCs in the market, yields around 6 to 7% and has grown its dividend consistently for years. A simple starting allocation might look like 50% in SCHD for long-term dividend growth, 30% in JEPI for higher current income, and 20% in MAIN or a similar high-quality BDC for additional yield. Blended together, that portfolio averages somewhere around 5 to 6% yield, which means you need roughly $100,000 to $120,000 invested to hit your $500 a month target. Now, the compounding trick that most beginners completely skip. Every single dividend payment you receive before you need the income, reinvest it, every dollar, immediately, automatically. Most brokerages offer automatic dividend reinvestment, called DRIP, at no additional cost. You turn it on once, and it runs in the background forever. When your dividend arrives, it buys more fractional shares of the same holding. Those new shares generate their own dividends at the next payment, which buy more shares, which generate more dividends. In the early years, this feels like rounding errors. In year 5, it starts to look meaningful. In year 10, it represents a substantial portion of your total portfolio value. Growth that came from income entirely separate from the money you were contributing out of pocket each month. The investors who reach $500 a month in dividend income fastest are almost never the ones who contributed the most money. They are the ones who reinvested every single dividend payment without exception throughout the accumulation phase and let the compounding do the heavy lifting alongside their contributions. Now let me make this concrete with a real timeline. Starting from zero with $200 a month in contributions, roughly $50 a week, invested into a blended portfolio averaging a 5.5% yield with dividends fully reinvested throughout, here is roughly what the progression looks like. At the end of year 1, you have contributed $2,400, and your portfolio is generating somewhere around $130 to $150 per year in dividends. Not enough to live on, but proof that the mechanism is real. By year 3, you have contributed around $7,200 in new money. Compounding and reinvestment have grown the total portfolio to somewhere in the $8,500 to $9,000 range. Annual dividends are now around $470 to $500 per year. By year 5, with continued $200 monthly contributions and full dividend reinvestment, the portfolio has grown to approximately $15,000 to $16,000. Annual dividends approaching $900. By year 8 to 10, the compounding becomes genuinely significant. Annual contributions are still the same $2,400 per year, but the dividend income is now contributing almost as much to portfolio growth as the contributions themselves. The portfolio reaches the $30,000 to $35,000 range, and annual dividend income is approaching $1,800 to $2,000. To reach the full $6,000 annual target, $500 a month, you are looking at roughly 15 to 18 years at $200 a month in contributions with full reinvestment. That timeline shortens dramatically if you can increase contributions over time as your income grows. If you get to $500 a month in contributions rather than $200, that same destination arrives in roughly 9 to 11 years. And here is the reframe that matters most. While you are building toward $500 a month in dividends, that income is already working for you. The $130 in year 1 is real income that buys real shares that generate real dividends at the next payment cycle. The journey toward the goal is itself generating the goal incrementally. You do not reach zero and then suddenly have $500 a month. You build from $10 a month to $20 to $50 to $100, and the momentum compounds at every step. Each milestone is real. Each dollar earned in dividends before you need it accelerates the next milestone. The hardest part of this entire strategy is starting. Not because the mechanics are complicated, they are genuinely simple. The hardest part is accepting that the first few years look small, while still trusting that the later years will look large. The people who never reach $500 a month in passive dividend income are overwhelmingly not the ones who tried and failed. They are the ones who never opened the account, never set up the automatic transfer, never bought the first fractional share because the amount felt too small to matter. It matters. Every single dollar you put in motion today is working for you from the moment it lands. Zero is not a barrier. Zero is just a starting number. The direction you move from zero is the only thing that counts. Now, the question I want your honest answer on before you leave: what is the single biggest thing stopping you right now from starting or accelerating your dividend income journey? Not enough money to start, not sure which investments to choose, or just have not gotten around to setting it up yet? Drop your real answer in the comments. I reply to every single one, and I will personally address the most common answers in a future video. Hit subscribe if you want to follow this journey every single week. I post real portfolio numbers, real dividend income updates, and breakdowns exactly like this one consistently. You do not need to figure this out alone. Let us build something real together.